Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, it was not an ideal way to come back into trading and start off 2023 on Tuesday, as we had a pretty much a down day across the board, across commodities, stocks, energies. We're going to talk about this as we get an idea of what we are seeing in this market trade. As we start off the new year, we welcome in Brian Splitt, agmarket.net, joining us today. Brian, good to catch up with you, buddy. Happy New Year. Hope you're doing well.
Yeah, good to be here as always, Jesse. Happy New Year to you and all the listeners.
Thanks for the time today and diving in to look at this market. I think just broadly to start, you and I were chatting off air. I have quite a few areas for us to go to today, but looking at us getting back to normal trading conditions, quote unquote, on Tuesday to start the new year, the dollar moved higher. It felt like some risk off pressure across the board with the dollar moving higher, but I know there's a lot of other things at play. But just to kind of set things up for our discussion today, did that feel like a bit of the case to you with the dollar moving higher, just kind of weighing on everything on Tuesday, Brian?
Yeah, I mean, I think that was definitely part of the narrative today, and the dollar being higher, might have been more of just a general risk-off attitude in commodities, and some strength in the old standby, which is the U.S. dollar. We had energies very weak today. We had livestock weak. We had several of the soft markets weak. We obviously had the grains weak today. So it was not just pointed at the grain markets. It was some selling across the board and selling in a lot of markets where the funds are holding a long position currently.
Well, and talking about that as well, getting into a new year, we typically see that money flow work its way around. And you mentioned that to me before we jumped on the air, a lot of long positions held by funds. And I think I saw a fair amount of contracts liquidated on Tuesday, 9,000 beans, 7,000 bean meal, 11,000 corn contracts. Last I looked, somewhere around those numbers. So thinking about that, why do we see a lot of that long liquidation coming back from the holidays and starting off a new year, Brian? What's behind some of that?
I do think when we think directly towards the ag commodities, funds holding long corn positions, long bean positions, very long on meal. And I think part of that length that was added between, let's call it mid-December to the end of the year, was some window dressing on their part. Getting the corn market to close near the highs of the month. As we finish up the year, getting beans to do that, getting meal to do that. And so with them holding those long positions, it seemed like it was maybe an effort to window dress those positions and get some good settlements to finish up the year, pad their returns on those specific markets. And then we have the long weekend. We ended up getting some rain in Argentina, and we can debate whether it was adequate or what it was compared to the forecast. But bottom line is we saw the fund manager come out and start to book some profits very earlier on the year on some of those long markets that they're holding.
Brian, let's dive in a little more on soybeans. And last week here during the show, we did a lot more looking back at 2022, looking ahead to 2023. I shied away from the fact that beans broke above that overhead resistance we've been talking about at $15, because I wanted to see what the market would do under normal trading conditions, normal volume, etc. We obviously gave a lot of that move back on Tuesday, falling below 15 in many of these soybean contracts. So as you look at the charts, starting the new year off, we see us come back below 15. What are your thoughts there? Can we get back above 15 and sustain that, or is this just a bit of a move back to where we were, considering we traded through the holidays that way. What's your thoughts in beans when you look at the charts right now?
Yeah, when you think about the old crop soybeans, we did go up and we closed gaps there. March, May, July, they all had gaps from June. We filled those gaps on the rally last week and traded through them a little bit. So I think that was significant that we kind of reached that upper objective and filled those gaps. We haven't taken out support yet, and so maybe that's what we need to do in order to feel like, well, we've lost $15, is to take support out. And so we've got some uptrends that have been established from the October lows. Those uptrends are still very much in place on old crop soybeans. And so I think we got to start taking out those uptrends, maybe get back below the 200 and the 100-day moving averages. And that might be something that signifies that we made more meaningful highs here to finish up the year. And you could probably say the same thing on new crop soybeans, where we got above 14, albeit just for a couple days, and now right back below 14. We didn't close aggressively below 14, so could we see $14 beans again tomorrow? Yeah, absolutely. I think it's something where, again, the uptrends are still in place. We're going to have to start taking out some of the lows that were made leading up to this run up. And so I think on November beans, we had some mid-December lows before this push to new highs that were right around that 1380 area. So if we start to see the other side of 1380 on the new crop soybeans, then that might signify that the high that we had last week might be more of a meaningful high. But until we do that, we could just possibly be coming back and revisiting support before making another push.
Well, and you brought up South American weather. Obviously, that's going to be a big key we're watching. And then also, too, demand with the Brazilian supplies coming on. We're getting some of that farmers selling out of South America, and China picking up more Brazilian supplies, that U.S. export window closing for soybeans. I know that's going to be a big talking point in this market here for the next few weeks ahead, isn't it, Brian?
It is. And so, Argentina has been one of the main talking points as far as the dryness there. We can nitpick Brazil, and it's Rio Grande do Sul is the area in the southern growing regions that's got that drier bias over the last several weeks. Otherwise, the majority of Brazil looks really good. And Brazil plus Argentina should have a record combined production number. So that's something that I think is going to weigh on things in the big picture. But we had a little rain over the weekend in Argentina, and one of the things is the meal market it was an inside bar from Friday, so we did trade lower today, but we didn't take out Friday's lows where we did on the soybeans and the bean oil. So until this meal market really shows that it's starting to roll over, it's hard to get too worked up about the bean market rolling over with it. But I do think once we see this meal market give up, that we could see that market have a rather aggressive break. And again, a lot of that has to do with just the sheer size of the fund length in that market. I will point out that spot meal, when you look at the lows that we had, we've retraced 62% of the whole break from the August high to the October low in meal with the highs that were made last week. So there's a gap around 491. And maybe the January contract will fill that before it expires. But we've also hit some of the upper echelon targets on the soy meal market on this rally.
Brian, over in the corn market, you mentioned that as well. I want to turn our attention there. End of last week, we tested some of that overhead resistance, and we look at the day we had Tuesday compared to beans and wheat. It was an okay day in corn Tuesday. We're still kind of hovering 670, 660 range in old crop, $6 range in new crop. As you look at the corn charts, what are some things that stand out to you? What are you watching here as we really get into this week?
Well, that high that was made on Friday, I think hit, maybe a confluence of maybe four different things of resistance on that specific chart for March. So number one, we had highs that were made in October, and then we had lows that were made early in December. And we retraced 62% of that break on that high on Friday last week. That high Friday was exactly 50 cents off of the low in December. So 685 high coming from a 635 low. big round number like that. When we made those highs in October, we had some secondary highs October 31st and then November 1st and 2nd that established a downtrend. That downtrend line was hit on the high on Friday. And then also when we were making those highs in October, we had some lows that were being made mid-month in that 683, 684 area. So we kind of went up and hit that shelf from underneath. So like I said, there's a confluence of about 4 different types of resistance that we hit. So one of the things that I had suggested to some producers that wanted to have some physical corn sold on this rally was, hey, maybe we sell that corn in the physical market. We'll just stay hedged. We'll put some stops in above last week's highs and see if we can't take these hedges off on a little bit more of a pullback. I do think that as we go into this January report, again, with the length from the funds, that we might see this market peel back a little bit further. And I think maybe revisiting that 655-ish area might not be a bad downside target to see if we can hit before the report January 12th.
Well, Brian, you mentioned a little bit of selling there on the corn market, and I think as well, corn, beans, I might sound like a broken record. I say this a lot, but rewarding the rallies, and I think about it as well, the calendar says 2023 now, so I wonder if that changes some mentality of producers who are saying, well, okay, now I'm in a new tax year. Okay, I'm all right making some sales and getting that on the books. I know sometimes that's a factor. I just wonder if we could see, a little bit of selling here this week to try and protect this rally, maybe getting some hedges in place, like you mentioned, just to try and protect some of what we have here with downside potential on the board, possibly heading to that January 12th report.
Yeah, there's some about the calendar flipping that, gets the producer to get a little bit interested in marketing again. I think a lot of the participants just really weren't paying much attention last week. It was the holidays, slow holiday trade, and if you're spending time with family, and that's fine. I mean, that's more important. But I think as the calendar's flipped, now we're looking at the potential for rent checks being due. We're looking at the producer saying, okay, I've locked in this for my chemical or my fertilizer, and maybe I should get enough, corn for new crops sold to at least cover those bills. And with the $6 price tag still available, I think you're starting to see the calendar starting to spur those thought processes here. And I've had a lot of producers that have kind of said, you know what, I know the market's rallied. I know I want to get some more sold before that January report. So their wheels are turning right now, trying to figure out if they, should just go ahead and move it, or if they try to look for a little bit of a bounce between, now and that report. But again, I think when you look at what we hit last week on that high, and we talked about all those different technical numbers, maybe the thing to do is just go ahead and move it. And I've had producers, July options, the volatility on July corn options is pretty cheap right now. You could replace some physical sales and just go out to July. July's trading at a discount to March. Buy a call spread in July, maybe a $7, $8 call spread. You can do that for under 20 cents. And that'll give you something to hold on to and participate in if we do have some kind of a domestic weather story that develops down the road.
Wheat market, real briefly, was that a case of the higher dollar, do you think, or was there something else you saw chart related? I know this KC wheat chart has been looking fairly good here the last couple of sessions. I just wonder what you saw on the wheat markets overall Tuesday, Brian.
Yeah, I think wheat's probably going to be one of the, the more sensitive ag commodity markets to the dollar movements. So I don't doubt that we had some pressure in wheat because of that. I'll also mention this, I put the most weight on hard red wheat. That's the highest, volume of wheat produced in the country. And I know even though we don't see the same volume on the board, the fund manager seems to like to play in Chicago wheat, but I think hard red is the most important wheat. And so I look at that, and we keep failing at the downtrend from the October highs. We did it again today. Something I continue to look at is how similar we're trading in wheat, in the hard red wheat, to 2008. We made a very sharp run up in 2008 up to near 1385. We came within about a nickel of that level on the highs that in 2022 after the invasion of Ukraine. And after that high was made, we've come back down we check $8 again, just like we did in 2008. We rallied off of $8. And my concern would be, based on the timing of '08, this month or next month, if we find ourselves below $8 on spot hard red wheat, it's going to be following that footprint from 2008. And that would suggest we go into the low sixes to upper fives. And I think just that alone is reason to carry some puts to at least cover $8 on production for new crop wheat that you don't have priced yet. And I know it's hard to want to sell it because it went in poor conditions, and the good to excellent probably isn't going to look real good coming out of dormancy. But I think you have to identify that if we break below $8, the chart's going to look horrible.
You brought up an interesting point there with 2008. Do you see any other commodities that have a similar look to them compared to, say, 2008? I've heard also some people comparing to 2013 maybe. Do you see anything else that has some similarities to that time frame, Brian?
Maybe not in the commodity market, but in the equity market, the structure of the S&P right now looks extremely similar to the structure of the S&P in 2008 before we had that last rollover. And that last rollover was the one that really, brought on the majority of the losses. So I look at the S&P and we've had some pretty aggressive movements here as of late. We saw, big move after that CPI number in December, went up just enough to hit the downtrend and ran some stops there. I think if we end up seeing the S&P on the other side of 3,500, that you're going to see what I think could be a pretty catastrophic move to the downside on the equity trade. So, you think back to what happened when they were pulling money out of equities in '08, and it pulled money out of everything. So I don't know if that's going to happen again this year, but if we become concerned about liquidity in general, and we see a liquidity event in equities, that could easily be a catalyst that takes the fund manager out of their long ag position.
Definitely. I want to give us time for livestock real quick. A down day there across cattle and hogs as well on Tuesday. I know a lot of folks still fairly bullish this cattle market as we start 2023. Just wondering your thoughts as we look at Tuesday's trade and just overall this protein sector as we start the year, Brian.
Yeah, so I think in live cattle, one of the things that the producer should realize is that the fundamentals, yes, are friendly. But you can protect yourself for what I think personally is pretty cheap premium. Live cattle options have been trading at 11-12% volatility. That is cheap. You could go to April, you could go to June and not spend very much to put a floor in, let's say at the lows that were made back in December. So maybe we had some lows in December on April live cattle in that 156, 157 area. We haven't really taken out support yet, even though you mentioned we were down today. But boy, I mean, for not much premium, you could establish a floor there, because we also have to realize is the fundamentals look good. We're still trading a market that needs demand. And I would say that cotton is a very good example of a market that this year had really good looking fundamentals, and we had production concerns, and all of a sudden the thought was that, hey, demand's not going to be here, and the market just collapsed in the face of what looked like strong fundamentals. So with a lot of the concern about a pending global or domestic recession, what good is live cattle here if the demand won't be there? And we don't know if it is or not, but I think puts are a very cheap way to put a floor in and still allow yourself to be bullish.
Does that same thought maybe spill over to the hog market too, just with all, especially added on the COVID issues in China and demand for pork over in Southeast Asia per se, especially China? Do we worry about some of those issues in the hog market as well, Brian?
So I think, yes, the part of this of what we talked about in live cattle, we could say in hogs, I think you're going to have an increase in production in early 2023. I think you've got that concern about China and what's going to happen with their COVID numbers and deaths, and do we start to see that affect the global marketplace? Unfortunately, the recent volatility in the hog futures makes the other part of the conversation we talked about in cattle not the case, which is low volatility options and being cheap to buy puts. Hogs have been extremely volatile over the last month or two. We've seen these big sweeping moves from the low 80s to the low 90s, back and forth. It seems like this market, once it gets its eye on a direction, it'll move 10 cents a hundredweight just before turning around and going 10 back the other way. So unfortunately, the hog options are not cheap. You're looking at, if you're buying puts, the volatility value on hog options is maybe close to triple what they are on the live cattle options. So similar sentiment as far as the concern about demand, for global and domestic economics. But again, the option volatility does not make them as cheap as the live cattle to protect.
Well, Brian, we'll wrap up our conversation there. And I know if folks have questions, want to talk to you and the team there at agmarket.net, they can get a hold of you very easily by going online. And I should mention as well, you guys' conference coming up February 5th and 6th in Nashville. I know we're looking forward to being there for that.
Yeah, we're looking forward to putting on a good showing for everybody. And like you said, that's 5th and 6th. So you can go to www.agmarket.net. There's a banner at the top of the page. You can click on the banner and get your information or get registered. And if you want to talk to somebody, call 844-4AG-MARKET. So 844-424-6758. My direct line is 815-665-0463.
With that, Brian Splitt, agmarket.net. Always a pleasure, sir. Enjoy the rest of your week, and we'll talk to you again soon. Thanks so much.
Thanks, Jesse. Appreciate it.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.